Friends, thank you for being here today. What if I told you that the financial mechanism used to price silver for the last 40 years broke permanently last Friday, leaving the global market in a state of unacknowledged insolvency? Why have major bullion dealers who exist solely to sell metal suddenly frozen their sales, hidden their inventory, or jacked up premiums to prohibitive levels at the precise moment demand is exploding? To understand the gravity of this moment, we must look beyond the green and red candles on a trading chart and stare directly into the engine room of the global banking system, an engine that has just seized up. We are standing at a precipice that few investors ever witness in their lifetimes. It is the transition point where a paper asset, traded in unlimited quantities on digital screens, is suddenly forced to reconcile with the hard, unyielding reality of physical scarcity. For decades, the silver market has operated on a script. It was a predictable, algorithmic theater where banks could suppress prices to manage sentiment and protect their short positions. But this past weekend, the lights in the skyscrapers of Manhattan and London burned all night, not in celebration, but in panic. The script has failed. The physical supply is gone, and the silence you hear from the bullion dealers is the sound of a market that has realized it cannot meet its obligations. To fully grasp why dealers are freezing sales, we must first examine the catalyst that triggered this entire cascade: the death of the Friday script and the unprecedented market close of 67.14. For veteran silver investors, Fridays have traditionally been days of psychological warfare. There has been a specific kind of silence that descends on Wall Street on a Friday evening, usually the silence of relief. But this past Friday, the silence was that of a bomb squad staring at a wire they failed to cut. For 40 years, this Friday script was executed with clockwork precision. Silver would often rally during the week, generating excitement and optimism among retail investors. Then, typically around 10 DOM New York time on Friday, a massive sell order would hit the futures market. This smash was designed to drop the price by $2 or more, ensuring the week closed weak. The goal was psychological: to ruin the weekend of the bullion holder, to make them feel foolish for holding, and to paint a bearish picture on the weekly charts. We saw the banks attempt this script again. They tried to smash the price at 65. They tried to wall it off at 66. But then something impossible happened. Instead of the price collapsing under the weight of paper selling, the buyers aggressed. They didn't just hold the line, they bought the offer. They cleared the order book. The market accelerated into the close, blowing the roof off the building to finish at the absolute highs of the week, $67.14. This number is not just a price. It is a crime scene evidence marker. It signifies that the suppression algorithm is broken. The bullion banks fired every bullet in their arsenal, and they ran out of ammunition before the market ran out of money. When a market closes at its absolute high on a Friday, it signals a profound psychological shift from fear to greed. Specifically, the market moved from a fear of crashing to a fear of not owning enough. Institutional buyers realized that the suppression game was over, and they became desperate to be positioned before the weekend, regardless of the price. Technically, this close has pushed silver into blue sky territory. Between $60 and $65, there was significant chop and noise, a battleground of buyers and sellers. But above $67, the air is thin. Looking back at monthly charts over the last 4 decades, there is almost no trading history at these levels. This means there are no bag holders from the past, no investors who bought at the top years ago and are waiting to sell to get their money back. Everyone holding silver right now is in profit, and people in massive profit do not panic sell. They hold for the moon. The only resistance left is psychological, round numbers like $70 or $75, but there are no structural walls of supply to stop the ascent. We have left the battle zone and entered the discovery zone, where the price seeks a new equilibrium that is much, much higher. Now that we understand the technical breakout, we must take you inside the weekend nightmare currently unfolding within the financial system. While retail investors celebrated the breakout, a disaster scenario began unfolding inside the risk management departments of major bullion banks. The breakdown of the Friday script has trapped commercial short sellers in a prison of their own making. These banks are holding billions of dollars in short positions, promises to sell silver they do not own, that are now deeply underwater. With the price at $67.14, they are losing more than $3 an ounce on millions of ounces. The crisis is exacerbated by the fact that markets are closed for the weekend. The banks are stuck. They cannot trade, they cannot hedge, and they cannot stop the bleeding. They are forced to sit for 48 hours, watching geopolitical tensions rise and reading viral reports about industrial shortages, knowing that every piece of bullish news will make the Sunday open even more violent. This situation has triggered a systemic variation margin crisis. Institutional funds do not operate like retail traders. They settle their wins and losses daily. When the price moved violently to $67.14, it caught hedge funds and commercial shorts completely off guard. Many of these entities were leveraged to the hilt, betting on a pullback that never came. When the closing bell rang, They were staring at losses that exceeded their cash on hand. This is where the weekend margin call occurs. It is not a computer flashing red. It is a phone call from a prime broker to a fund manager on a Saturday morning. The message is brutal. You are down $500 million. You have exceeded your credit limit. We need you to wire $300 million by 8 a.m. Monday morning. If the fund manager cannot liquefy other assets to make that wire, the bank takes control. The prime broker's risk protocol takes over with a single instruction: close the position. Because these funds are short, closing the position means buying. It means buying at any price. It means issuing market on open buy orders for Sunday night or Monday morning. This forced liquidation creates a domino effect. It isn't people rushing to buy because they love silver. It is banks rushing to buy because they are terrified of their own clients defaulting. If the price gaps up to $68 or $69 on this forced buying, the next tier of funds gets the margin call, creating a cascade of defaults. Simultaneously, a quiet bank run is happening on the vaults. For years, banks have sold unallocated silver to wealthy clients and family offices. Unallocated silver is essentially a claim on a pool of metal that the bank uses for its own trading and leasing operations, a fractional reserve system. But with the price skyrocketing and rumors of shortages swirling, confidence in this paper promise has evaporated. We are seeing reports of billionaires and family offices demanding the conversion of their unallocated holdings to allocated storage. They want their names on specific bars, moved to segregated shelves, with serial numbers provided. This forces the banks to show their hand. If they have leased that silver out to industry or sold it to China, they do not have it. To avoid a lawsuit and a total collapse of confidence, they must go into the physical market and secretly buy bars at any price, $68, $70, whatever it takes, to satisfy these client demands. This internal squeeze is invisible to the retail trader, but it is a driving force behind the price resilience. This financial paralysis naturally leads us to the physical freeze, raising the question, if the price is so high, why are dealers refusing to sell? Logic suggests that high prices should unleash supply, but the opposite is happening. We are witnessing a phenomenon known as the physical freeze, where the machinery of the silver market grinds to a halt because the cost of doing business has become mathematically impossible. The epicenter of this freeze is the sudden catastrophic spike in silver lease rates. Most investors do not understand that the entire backbone of the silver industry, refiners, mints, and wholesalers, relies on leasing metal, not owning it. A refinery, for example, does not want to take the risk that the price of silver drops while they are processing scrap metal. They are in the business of refining, not gambling. To hedge their risk, they lease silver or use repo agreements to free up capital while they work. Normally, lease rates for silver are negligible, less than 1% or 2%. It is a minor cost of doing business, barely a rounding error for a major mint like the Royal Canadian Mint or a large refinery. However, in the wake of the shortage, lease rates have exploded. We have received reports of rates jumping to 12%, then 30%, and in some overnight markets, exceeding 100% annualized. Imagine you are leasing a car, and suddenly the rental company tells you the interest rate on your lease has gone from 2% to 100% overnight. You would return the car immediately. This is what is happening to refiners. The cost to borrow the metal they need to facilitate their operations has become so high that they cannot turn a profit. As a result, they simply stop buying. This explains the sudden halt in the purchase of junk 90% silver and scrap. On Friday, multiple major wholesalers and refineries sent out notices that they were suspending the purchase of 90% silver. They cannot afford to take the product in, hedge it via leasing, and refine it because the financing costs destroy their margin. This has cratered the market for secondary silver. Local coin shops are being told their inventory is essentially frozen because the upstream buyers have left the building. Furthermore, dealers are facing replacement cost risk. In a violent bull market, selling inventory is dangerous. Imagine a coin dealer sells 1,000 ounces of silver on Friday morning based on a spot price of $64. They take the customer as cash and promise delivery. They expect to call their wholesaler on Monday to restock those 1,000 ounces. But if the market gaps up to $70 on Monday and premiums rise, that dealer might have to pay $72 or $75 to replace the metal they just sold for $64. They take a massive loss on every ounce they moved. To protect themselves from bleeding capital, dealers have gone into defense mode. If you look at dealer websites, you see sold-out banners on items that might actually be in the vault. You see maintenance mode screens appearing conveniently during price spikes. Or, most telling of all, you see massive premiums. Dealers are jacking up the price over spot to effectively price silver at $80 or more. They are doing this to discourage you from buying until they know the price is real. They are freezing the flow of metal because the paper price has become too volatile to trust. I want to pause here for a moment because this is critical. I'm curious to hear what you're experiencing on the ground. If you walked into your local coin shop today, were the shelves full or empty? Drop a comment below and let us know what the premiums look like in your area. Are dealers selling or are they holding back? Your on-the-ground intelligence helps everyone in this community understand the real scope of this shortage. However, the issue extends far beyond local dealers. We are witnessing a global drain driven by the Shanghai magnet and industrial panic. While the Western financial system chokes on paper derivatives and lease rates, a much simpler and more brutal dynamic is playing out in the East. There's a massive arbitrage gap opening up between the COMEX price in New York and the Shanghai Gold Exchange in China. With the COMEX closing around $67, silver in China has been trading significantly higher, often pushing the equivalent of $72 or more. In the world of commodities, a $5 arbitrage spread is a black hole with infinite gravity. It dictates the flow of physical matter. If you are a global refiner or a mining company, you will not send your silver to New York to be sold for $67 when you can send it to Shanghai and receive $72. This spread is sucking every available 1,000-ounce bar out of Western vaults. We are witnessing a physical drain, where inventory is being put on pallets, loaded onto planes because ships are too slow for this level of panic, and flown to China. This creates a supply shock in the West. The metal that usually replenishes the COMEX vaults is being diverted. The registered inventory at the COMEX, the metal legally available to settle contracts, is evaporating. If this number gets close to zero, the exchange will be forced to declare force majeure, settling contracts in cash because they have no metal to deliver. This would mark the official death of the paper market. But the drain isn't just geographical, it is industrial. We are seeing a complete bifurcation of the market into public and private spheres. In a normal market, companies like Samsung, Tesla, or Apple might buy futures contracts to hedge their silver costs. But in a shortage, a paper contract is useless. You cannot build a solar panel or an electric vehicle with a slip of paper. You need physical atoms. Consequently, these industrial giants are bypassing the exchanges entirely. They are conducting off-market mine gate deals. We are hearing reports of major tech and solar companies calling mining corporations directly and offering to buy their entire production for the next 2 years at a premium, picking it up directly at the mine. This leads us to a crucial realization that most market analysts are missing: the strategic singularity. We must broaden our lens to understand that we are no longer dealing with a simple commodity trade. We are witnessing the collision of inelastic industrial demand with hard geopolitical reality. In the past, when silver prices rose, industries might have looked for substitutes. But today, in the age of green energy and high-tech warfare, there are no substitutes. Silver is the most conductive metal on the periodic table. You cannot build an advanced cruise missile, a high-efficiency EV battery, or a top-tier solar panel with copper or aluminum. Physics simply does not allow it. Consider the perspective of the boots on the ground. The solar electricians and engineers installing these systems daily. They know what the financial markets ignore. The demand is structural and government mandated. Governments across the globe, from India to the European Union, have legally mandated the transition to renewable energy. This means the demand for silver is no longer a choice. It is a law. A solar manufacturer who produces panels where silver is a small fraction of the total cost is price inelastic. This means that if silver goes from $70 to $150, they do not stop buying. They cannot stop buying, because stopping means shutting down a billion-dollar factory and failing to meet government contracts. They will simply pass the cost of that silver, perhaps an extra $20 or $50 per panel, down the line to the consumer. The same applies to electric vehicles. If a Tesla costs $1,000 more because of silver, the consumer pays it. The industry will absorb any price to secure the metal, which makes the upside price potential of silver virtually unlimited in the short term. The industry will pay $500 an ounce before they turn off the lights. Furthermore, this industrial desperation is happening against the backdrop of a monetary war. We are seeing a strategic pivot where silver is being reclaimed as a national security asset. Recent executive orders have classified silver as a critical mineral, acknowledging that the U.S. is dangerously dependent on imports. Meanwhile, the BRICS nations, Brazil, Russia, India, China, South Africa, are actively de-dollarizing their economies. We have confirmation that the new trade settlement currency being developed by this bloc, the unit, is structured to be backed 40% by gold and underlying commodities. What happens to gold inevitably happens to silver, but with greater volatility. Russia has been quietly accumulating silver reserves, and China has explicitly signaled its intent to restrict silver exports starting January 1st to protect its domestic solar dominance. Think about the implications of that export ban. China is the world's second largest producer of silver and the largest consumer. If they lock their gates on January 1st, the Western world loses a massive supply line overnight. This is the geopolitical checkmate. The West spent decades suppressing the price of precious metals to maintain faith in fiat currencies like the dollar and the euro. In doing so, they allowed the East to drain their vaults at bargain basement prices. Now, the West needs that silver back to build the green economy of the future. But the East is refusing to sell. The vault is empty, the miners are booked, and the hostile powers holding the metal are launching a gold-backed currency to rival the dollar. This is why the spot price is broken. It is trying to price a legacy financial asset in a world that now views silver as a weapon of strategic energy independence. Given this backdrop, we must now turn our attention to the market mechanics and the future outlook. So, where do we go from here? The immediate future is likely to be volatile and violent. We are setting up for a potential gap and go on Monday morning. If the margin calls are enforced and the banks are forced to panic buy, we could see the price open significantly higher than the 67.14 close, perhaps at 68.50 or 69. This creates a gap on the chart, a vacuum where no trading occurred. However, experienced traders know to be cautious of the gap fill. Markets rarely go up in a straight line forever. Often, after a massive panic spike, the price will drift back down to test the breakout level, in this case, the 16-seller mark, to ensure it is solid support. This is a trap for the emotional investor. If you panic, buy the spike at $69 and the banks engineer a washout to $67 to clear out the leverage, you will be shaken out just before the real move begins. The smart money waits for the retest. They let the price come back to them. We must also be aware of the rug pull scenario. Sunday night trading is notoriously illiquid. It is possible the banks will use this thin volume to dump paper contracts, trying to paint a weak picture and trigger stop losses below 65. But this is a dangerous game for them. Any dip in price is now being met with ferocious physical buying. The lower they push the paper price, the faster the physical metal leaves the vaults. The target everyone is watching is $70. This is the final war zone. Below $70, the skeptics can still argue this is just a correction or a double top. But if the price breaks $70, the chart goes vertical. The bear thesis is destroyed. $70 is the psychological barrier that separates the old world from the new. Once we breach it, we enter a volatility vacuum where moves of $5 or $10 a day become normal. In the longer term, looking at the next 3 months, the floor has shifted. The 200-day moving average, once a distant anchor, is rapidly resetting to levels that would have seemed impossible a year ago, likely around $40. We are hearing projections from credible sources, including those embedded in the industrial sector, that we may not see silver below $100 again within a quarter. This is not hyperbole. It is a reflection of the repricing of a strategic asset that has been artificially suppressed for half a century. Before we get to the final verdict, if you are finding value in this breakdown of the silver crisis, please take a second to like this video and subscribe to the channel. It really helps us bypass the algorithm and get this critical information to more investors who need to hear it. Your support allows us to keep digging where the mainstream media refuses to look. Now, let's bring it all home. Ultimately, all these factors point to one conclusion. We are witnessing the end of the paper fiction. Friends, what we are witnessing is not just a bull market, it is a systemic failure of trust. The surge in silver is driven by supply and demand, yes, but it is fueled by a collapse in faith in the banking system. When the Federal Reserve is printing money to the tune of $40 billion a month in QE, and when banks cannot honor their unallocated liabilities, investors flee to the only asset that has no counterparty risk. The divergence between the spot price and the physical price is the death knell of the current currency system. We are entering a phase where the spot price you see on your phone is becoming a fiction, a reference rate for paper gambling that has no bearing on reality. If you call a dealer today and try to buy silver at 67 ounces, they will laugh. The real price is $78, CD dollars, or whatever the holder demands. The premium is not a surcharge. It is the real price asserting itself over the paper lie. The freeze at the refineries, the panic in the bank risk rooms, and the empty vaults in London are all signaling the same thing. The physical silver supply is gone. It has been consumed by industry, hoarded by China, and stacked by prepared individuals. The game of musical chairs is ending, and the banks are the ones without a seat. Do not let the volatility shake you. Whether we gap up to $69 or retest $65, the trend has changed. The flow of metal has changed. The psychology has changed. You are holding an asset that is being repriced by the entire world simultaneously. Stay sharp, stay stacked, and do not be fooled by the paper price. The real value is in your hand, and for the first time in history, the world is waking up to realize just how much that is worth. Thank you.